Let us imagine a scenario where management tries to tie your hands before you even walk through the door. This brings us to the concept of a limitation on scope prior to audit engagement acceptance. The logic here is straightforward if management or those charged with governance impose a restriction on the scope of your work in the terms of a proposed audit engagement, and you believe this limitation will ultimately result in you having to disclaim an opinion on the financial statements. You must not accept such a limited engagement.
An auditor is there to provide reasonable assurance, and if you know from day one that you will not be able to gather enough evidence to form an opinion, accepting the engagement would be a disservice to the stakeholders. The only time you might be forced to accept such an engagement is if you are specifically required by law or regulation to do so. Otherwise, your professional standards tell you to walk away.
To help you remember this, just think of the phrase "no scope, no hope." If there is no scope to perform the necessary procedures, there is no hope of providing a valid opinion, and therefore, no reason to accept the engagement. It is your first line of defense in maintaining your professional integrity and the quality of the audit process.
Let us move on to the second part of Standard on Auditing 210, focusing on acceptance of change in terms and recurring audits. Acceptance of change in terms: imagine you are halfway through an audit, and management suddenly asks you to change the engagement to a review or a compilation, which provides a lower level of assurance. You cannot just blindly agree. You must first evaluate if there is a reasonable justification for this request.
There are three main scenarios where such a request usually originates. First, a change in circumstances might have occurred that genuinely affects the entity's requirements. Second, there might have been a simple misunderstanding about the nature of the audit service that was originally requested. Third, management might be trying to impose a scope restriction on your work.
If you find that the request is based on a reasonable justification, such as a misunderstanding or changed circumstances, you can agree to the new terms. In this case, to avoid confusion, the auditor and management should record the new terms in a fresh engagement letter or another suitable written agreement. It is important to note that the new report should not refer to the original audit procedures, except perhaps in an agreed-upon procedures engagement. However, if the auditor concludes that there is no reasonable justification for the change and management does not permit the original audit to continue, the auditor must take action. You are required to withdraw from the audit engagement where possible under applicable law or regulation. Furthermore, you must determine whether you have a professional or legal obligation to report these circumstances to those charged with governance, the owners, or even regulatory authorities.
Recurring audits. Let's talk about recurring audits. In a long-term relationship with a client, do you need to issue a new engagement letter every year? Not always, but you must still evaluate whether the terms need to be updated. There are 8 specific factors that might make it necessary to send a new letter or remind the client of existing terms. By keeping the REVISED factors in mind, you can ensure that the legal foundation of your audit remains accurate year after year.
To help you remember these for the exam, let's use the mnemonic REVISED first. R stands for reporting changes, specifically a change in other reporting requirements. Second, E represents a change in the entity, meaning a significant change in the nature or size of the entity's business. Third, V is for very important people, which refers to a recent change of senior management. Fourth, I stands for indication of misunderstanding, where the auditor feels the entity does not clearly understand the audit's objective or scope. Fifth, S is for special or revised terms of the audit engagement. Sixth, E represents equity, meaning a significant change in the ownership of the company. Seventh, D stands for dictated by law, referring to changes in legal or regulatory requirements. Finally, the eighth point is a change in the financial reporting framework used to prepare the statements.
We move into the actual physical and digital organization of your work, which is governed by Standard on Auditing 230. Specifically, let us look at the assembly of the final audit file. Once you have finished your work and signed the report, you might think the job is done. But there is a crucial administrative phase you must follow to keep your work organized and legally compliant. Assembly of final audit file, the logic here is to create a permanent record that is complete and ready for any future review or inspection. You must realize that this is strictly an administrative process and not a time to perform new audit procedures or reach new conclusions.
The firm must establish policies and procedures designed to maintain the confidentiality, safe custody, integrity, accessibility, and retrievability of this documentation. This ensures that the work remains protected from unauthorized changes and is available when needed for quality reviews or legal inquiries.
There is a very specific technical timeline you must memorize for the exam. The assembly of the final audit file must be completed within 60 days after the date of the auditor report. This 60-day window is essentially for house cleaning. You are permitted to delete or discard superseded documentation. You can sort and cross-reference your working papers, and you can sign off on completion checklists that relate to the file assembly process itself. You can also document audit evidence that you had already obtained and discussed with members of the engagement team before the date of the report.
If you find it necessary to modify existing audit documentation or add new documentation after the assembly of the final audit file is complete, you must record 3 specific things regardless of the nature of the modifications. First, you must record the specific reasons for making the changes. Second, you must record when and by whom the changes were made and reviewed. Finally, you must record the effect of those changes on the auditor conclusions.
To help you remember the assembly phase rules, let us use the mnemonic TIDYT, stands for time limit, which is 60 days. I represents internal cross-referencing and sorting. D for deleting superseded or duplicated documents. Y stands for yes to finishing administrative sign-offs. Regarding the legal aspect, you must remember that audit documentation is the property of the auditor. While the auditor can, at their discretion, make portions of or extracts from the documentation available to clients, this must not undermine the validity of the work performed or the independence of the firm.
Finally, let us look at the retention period. According to Standard on Quality Control 1, the firm must establish policies for the retention of engagement documentation. This period is generally not shorter than 7 years from the date of the auditor report, or if later, the date of the group auditor report. So remember, you have 60 days to get TIDY and 7 years to keep it. SAFES stands for 7 years. A for auditor ownership. F for final file assembly. E for evidence retention.
We move into Standard on Auditing 240, which deals with the auditor responsibilities relating to fraud. Before we dive into the auditor's specific duties, we must establish where the primary responsibility for fraud resides. Primary responsibility, the logic here starts with a technical definition. Fraud is an intentional act by one or more individuals among management, those charged with governance, employees, or third parties, involving the use of deception to obtain an unjust or illegal advantage. This distinguishes it from error, which is unintentional. As auditors, we are specifically concerned with fraud that causes a material misstatement in the financial statements.
The standard makes it very clear that the primary responsibility for the prevention and detection of fraud rests with both those charged with governance of the entity and management. It is their responsibility to ensure an emphasis on fraud prevention, which reduces opportunities for fraud to take place, and fraud deterrence, which could persuade individuals not to commit fraud because of the likelihood of detection and punishment. Management, with the oversight of those charged with governance, must create a culture of honesty and ethical behavior. This involves implementing and maintaining internal controls designed to prevent and detect fraud. They are the first line of defense.
To help you remember this for your exam, think of the mnemonic TAMET stands for those charged with governance. A is for accountability, M for management, E for ethical culture. It is the job of TCWG and management to TAME the risk of fraud through accountability and an ethical culture.
The standard also identifies two types of intentional misstatements that are relevant to the auditor. First, misstatements resulting from fraudulent financial reporting, and second, misstatements resulting from the misappropriation of assets. Fraudulent financial reporting involves intentional misstatements, including omissions of amounts or disclosures in financial statements to deceive users. Misappropriation of assets involves the theft of an entity's assets and is often perpetrated by employees in relatively small and immaterial amounts. However, it can also involve management, who are usually more able to disguise or conceal misappropriations in ways that are difficult to detect.
Now that we understand who is primarily responsible for preventing and detecting fraud, let us look at our own specific duties as auditors under this standard. Auditor responsibilities, our core objective, is to obtain reasonable assurance that the financial statements as a whole are free from material misstatement, whether caused by fraud or error.
However, we have to be very realistic here. Because of the inherent limitations of an audit, there is an unavoidable risk that some material misstatements may not be detected, even if the audit is properly planned and performed in accordance with the standards. This risk of non-detection is significantly higher in the case of fraud compared to simple errors. The logic is that fraud is usually accompanied by sophisticated and carefully organized schemes designed to hide it. We are talking about things like forgery, a deliberate failure to record transactions, or intentional misrepresentations made directly to us.
When people collude, it can make false evidence look incredibly persuasive, leading us to believe that the audit evidence is valid when it actually is not. We also need to acknowledge that management fraud is much harder to catch than employee fraud. This is because management is frequently in a position to directly or indirectly manipulate accounting records, present fraudulent financial information, or simply override the control procedures that were designed to prevent similar frauds by other employees.
So, how do we respond to these challenges? The standard requires us to do two main things. First, we must maintain professional skepticism throughout the entire audit. This means we do not just assume management is honest based on our past experiences with them or their past integrity. We keep a questioning mind. Second, we must recognize that audit procedures that are effective for detecting error may not be effective in detecting fraud. We have to stay alert to the potential for management override of controls.
To help you remember these responsibilities for your exam, I want you to use the mnemonic SLOP. S stands for professional skepticism, which must be maintained throughout the audit regardless of management integrity. L represents the inherent limitations of an audit, which are especially significant in the case of fraud. O stands for the potential for management override of controls, which we must always consider. P is for the audit procedures we design, recognizing that they must be responsive to fraud risks specifically. E stands for obtaining reasonable assurance about the entire financial statements being free from material misstatement. By keeping the SLOP factors in mind, you can clearly define the boundaries and expectations of the auditor's role when it comes to fraud.
Let us move deeper into the specific procedures we use to find these risks, which are known as risk assessment procedures. The standard requires us to perform these procedures to gather information for identifying risks of material misstatement due to fraud. This is not a passive process. First, we make inquiries of management, individuals within the internal audit function, and others in the entity who might have information. Second, we speak with those charged with governance to understand how they exercise oversight of management processes for identifying and responding to fraud risks. Third, we perform analytical procedures to look for unexpected or unusual relationships that might indicate fraud. Finally, we must evaluate whether information obtained from our other activities indicates that fraud risk factors are present. A helpful mnemonic to remember these steps is IMA stands for analytical procedures. I stands for inquiries. M stands for misstatement and fraud risk factors.
Management override techniques, moving on to how management might bypass their own rules. We must specifically address management override techniques. Management is in a unique position to commit fraud because they can manipulate accounting records and prepare fraudulent financial statements by overriding controls that otherwise appear to be operating effectively. To respond to this risk, the standard requires us to perform 3 specific procedures. First, we test the appropriateness of journal entries recorded in the general ledger and other adjustments made in the preparation of the financial statements. Second, we review accounting estimates for biases and evaluate whether the circumstances producing the bias represent a risk of material misstatement due to fraud. Third, for significant transactions that are outside the normal course of business or appear unusual, we evaluate whether the business rationale suggests they may have been entered into to engage in fraudulent financial reporting or to conceal misappropriation of assets.
Written representations as a crucial part of our audit evidence, we are required to obtain written representations from management. This is much more than a formality. In these representations, management must acknowledge their responsibility for the design, implementation, and maintenance of internal control to prevent and detect fraud. They must also confirm that they have disclosed to us the results of their own assessment of the risk, that the financial statements may be materially misstated due to fraud. Furthermore, they must disclose their knowledge of any actual, suspected, or alleged fraud affecting the entity. If management refuses to provide these representations, it brings into question their integrity and may lead the auditor to re-evaluate the reliability of other evidence.
Communication is a vital duty under this standard. If the auditor has identified a fraud or obtained information that indicates a fraud may exist, they must communicate these matters on a timely basis to the appropriate level of management. If the fraud involves management, employees with significant roles in internal control, or results in a material misstatement, the auditor must communicate these matters to those charged with governance. Beyond the entity, the auditor must determine if they have a legal or professional responsibility to report to regulatory and enforcement authorities. For example, under Section 14,312 of the Companies Act, if a fraud involves 1 crore rupees or above, the auditor must report it to the central government. In other cases, like the audit of banks, there is a statutory duty to report frauds to the Reserve Bank of India.
Evaluation of evidence. Finally, we must perform an evaluation of the audit evidence gathered.
At the end of the audit, we perform analytical procedures to determine whether the financial statements as a whole are consistent with our understanding of the entity. If we identify a misstatement, we must evaluate whether it is indicative of fraud.
If there is such an indication, we have to consider the implications for other aspects of the audit, particularly the reliability of management representations, because an instance of fraud is unlikely to be an isolated occurrence.
If the auditor confirms that the financial statements are materially misstated due to fraud and is unable to continue the engagement, they must consider their professional and legal responsibilities, including the possibility of withdrawing from the audit.
Let us move on to Standard on Auditing 250, which deals with the consideration of laws and regulations in an audit of financial statements. We will begin with the first logical area, which is the responsibility of management and the auditor regarding non-compliance.
Responsibility of management and auditor regarding non-compliance. The basic logic of this standard is that entities do not operate in a vacuum. They are subject to a legal and regulatory framework. It is the responsibility of management, with the oversight of those charged with governance, to ensure that the entity's operations are conducted in accordance with these laws. This includes ensuring compliance with the specific provisions that determine the reported amounts and disclosures in the financial statements.
To achieve this, management should implement policies such as maintaining a register of significant laws for their industry and recording any complaints. In larger entities, these policies are often supplemented by assigning specific responsibilities to an internal audit function, an audit committee, or a compliance function.
As for the auditor, you must understand a key distinction. You are not responsible for preventing non-compliance, and you cannot be expected to detect non-compliance with all laws and regulations. Your responsibility is to obtain reasonable assurance that the financial statements, taken as a whole, are free from material misstatement, whether caused by fraud or error. In conducting the audit, you must take into account the applicable legal and regulatory framework.
However, there is an unavoidable risk that some material misstatements may not be detected, even if the audit is properly planned and performed in accordance with the standards. This risk of non-detection is significantly higher for non-compliance than for simple errors or even some frauds. The logic here is that many laws relate principally to the operating aspects of an entity that typically do not affect the financial statements and are not captured by the entity's information systems relevant to financial reporting.
Furthermore, non-compliance may involve conduct designed to conceal it, such as collusion, forgery, deliberate failure to record transactions, management override of controls, or intentional misrepresentations made to you. Ultimately, whether an act constitutes non-compliance is a matter for legal determination, which is beyond the auditor's professional competence.
To help you remember the core responsibilities here, use the mnemonic MARM stands for Management Compliance Duty. O is for Auditor Objective of Reasonable Assurance. R is for the inherent risk of non-detection, which is significantly higher for legal issues.
Audit procedures for identified non-compliance. Let us imagine you have actually found a red flag during your fieldwork. What exactly are you required to do next? If you become aware of information concerning an instance of non-compliance or even just suspect it, the standard requires you to take specific steps to investigate. First, you must obtain a deep understanding of the nature of the act and the specific circumstances in which it occurred. You cannot form a judgment without context.
Second, you must gather further information to evaluate the possible monetary and disclosure effect on the financial statements. This isn't just about whether a rule was broken, it is about how that breach ripples through the balance sheet and profit and loss account. If your suspicions persist, you are mandated to discuss the matter with management, and where appropriate, those charged with governance. This gives the entity a chance to provide evidence of compliance.
But what if they are stonewalling you? If management or those charged with governance do not provide sufficient information that supports the entity's compliance, and you believe the effect of the suspected non-compliance could be material to the financial statements, you must consider the need to obtain legal advice. This acts as your professional safety net to understand the legal implications you might not be trained to see. Furthermore, if you find that sufficient information about the suspected non-compliance simply cannot be obtained, you must evaluate how this lack of sufficient appropriate audit evidence affects your final audit opinion.
You also need to look at the bigger picture and evaluate the implications of this non-compliance for other parts of your audit. Specifically, you must reconsider your initial risk assessment and the overall reliability of management's written representations. If they lied or omitted facts about a legal matter, can you really trust them on other assertions? To help you remember these procedure steps for your exam, think of the mnemonic IDEA. I stands for gathering information on the nature and circumstances. D is for discussing the matter with management and those charged with governance. E represents evaluating the effect on your audit opinion. O is for assessing the implications for your risk assessment and representations. Just remember to use your IDEA to handle suspected legal breaches.
Let us conclude our discussion on Standard on Auditing 250 by looking at the final logical area, which is reporting. The logic behind the reporting requirements is to ensure that significant issues are escalated to the right level of authority within the entity and, if necessary, to outside regulators.
Reporting first, we look at communication with those charged with governance. As an auditor, you are required to communicate matters involving non-compliance with laws and regulations that come to your attention during the course of the audit, unless all of those charged with governance are involved in managing the entity and are therefore already aware of the matter. If you identify or suspect that management or those charged with governance are themselves involved in the non-compliance, you should communicate the matter to the next higher level of authority in the entity, such as an audit committee or a supervisory board.
If you find that no such higher authority exists, or if you believe that the communication might not be acted upon, you must consider the need to obtain legal advice to determine the appropriate course of action.
Second, let us consider the impact on your audit report. If you conclude that the identified or suspected non-compliance has a material effect on the financial statements and has not been adequately reflected or disclosed, you are required to express a qualified opinion or an adverse opinion in accordance with Standard on Auditing 705. On the other hand, if management or those charged with governance prevent you from obtaining sufficient appropriate audit evidence to evaluate whether non-compliance that may be material has occurred, you must express a qualified opinion or disclaim an opinion, because there is a limitation on the scope of the audit.
Finally, there is the matter of reporting to regulatory and enforcement authorities. You must determine whether your responsibility to report identified or suspected non-compliance to parties outside the entity overrides your professional duty of confidentiality. In many circumstances, law or regulation specifically requires the auditor to report breaches to regulators or government bodies, such as reporting fraud or significant legal noncompliance to the central government under the Companies Act.
To help you remember these reporting tiers for your exam, use the mnemonic CORC, stands for communication with those charged with governance. O represents the impact on your audit opinion. R is for the potential responsibility to report to regulatory authorities. Just remember to check the COR of reporting whenever laws are broken.
We are stepping into a very modern and critical area of professional ethics, known as NOCLAR, which stands for Noncompliance with Laws and Regulations. While SA 250 focuses on the financial statement impact, NOCLAR is a much broader ethical framework included in the revised Code of Ethics. It is designed to ensure that professional accountants do not turn a blind eye to illegal acts that could harm the public interest.
Important facts about NOCLAR. The logic behind NOCLAR is to protect stakeholders, which it specifically defines as investors, creditors, employees, and the general public.
In India, this framework has a specific applicability. For professional accountants in service, it applies to senior accountants, typically key managerial personnel working in listed entities. For those of us in public practice, it applies to audit engagements of listed entities that have a net worth of 250 crore rupees or more.
Expertise not required. A common concern is whether an auditor must now become a legal expert. The standard is very clear: expertise in law is not required. You are expected to apply your professional knowledge and exercise judgment, but you are not expected to have a level of knowledge greater than what is required for your audit engagement. Whether an act technically constitutes noncompliance is ultimately a matter for a court of law to decide, not the auditor.
Matters out of purview, there are also specific boundaries to this responsibility. NOCLAR does not address personal misconduct that is completely unrelated to the business activities of the client or the employer. It also does not cover noncompliance committed by parties other than the client, management, those charged with governance, or individuals working under their direction.
Steps to respond when you encounter a potential case of noncompliance. You must follow a systematic set of steps to respond. To help you remember this process for the exam, let us use the mnemonic UASFDD first. U stands for obtaining an understanding of the matter and the nature of the act. Second, O is for addressing the matter with management and those charged with governance to ensure they take corrective action. Third, S represents seeking advice, which might involve consulting internally within your firm or getting legal counsel. Fourth, F is for determining if further action is needed, such as disclosing the matter to a regulator or even withdrawing from the engagement. Fifth, D stands for determining whether to disclose the matter to an appropriate authority. Finally, the second D is for documentation, where you must record the results of your discussions and the judgments you made.
Disclosure to authority, a revolutionary aspect of NOCLAR, is how it handles the duty of confidentiality. In exceptional circumstances, if you become aware of an imminent breach of law that would cause substantial harm to stakeholders, you are permitted to disclose the matter immediately to an appropriate authority, like SCBI, to mitigate the consequences. This provision recognizes that the public interest can sometimes override professional confidentiality. So remember the mnemonic UASFDD to guide your response whenever you face a legal red flag. This framework ensures you act as a responsible professional, not just a bean counter.
Let us move forward to Standard on Auditing 260, which deals with the auditor's communication with those charged with governance. Commonly referred to as TCWG, the logic behind this standard is that effective two-way communication is crucial. It assists both the auditor and those charged with governance in understanding audit-related matters in context and in developing a constructive working relationship.
Communication to those charged with governance TCWG, the first major area of communication, is providing an overview of the planned scope and timing of the audit. This is not just a high-level summary, It specifically includes communicating the significant risks identified by the auditor during the risk assessment process. The logic here is that sharing these risks helps those charged with governance understand the matters that require special audit consideration and assists them in fulfilling their own responsibility to oversee the financial reporting process.
However, you must maintain a very clear professional boundary. While these discussions assist the auditor in planning, they do not change the fact that the auditor has the sole responsibility for establishing the overall audit strategy and the detailed audit plan. This includes determining the nature, timing, and extent of the procedures necessary to obtain sufficient appropriate audit evidence.
Significant difficulties during these communications, you must exercise a great deal of professional care so as not to compromise the effectiveness of the audit. For example, if you were to discuss the exact nature and timing of your detailed audit procedures with management or TCWG, it could make those procedures too predictable. Predictability is the enemy of a high-quality audit because it allows someone to potentially hide misstatements. Therefore, you share the what and why of your risks, but you remain guarded about the how and when of your specific tests.
Independence communication for listed entities for audits of financial statements of listed entities. The standard introduces a mandatory requirement regarding independence. The auditor is required to communicate with those charged with governance about compliance with relevant ethical requirements, including independence. This discussion should cover all relationships and other matters between the firm, network firms, and the entity that may reasonably be thought to bear on independence. You must also communicate the related safeguards that have been applied to eliminate identified threats or reduce them to an acceptable level. This ensures that those responsible for oversight are fully aware of any potential conflicts and how they are being managed.
To help you remember these communication pillars for your exam, let us use the mnemonic SDARS stands for the planned scope of the audit. T represents the plan timing. A is for the auditor's sole responsibility for the strategy and plan. R stands for the significant risks identified. Just remember to reach for the SDAR to ensure your communication with governance is complete and professional.
Let us move forward from our general discussions on communication to a very specific and critical standard, which is Standard on Auditing 265. This standard deals with communicating deficiencies in internal control to those charged with governance and management. The logic here is that, while our audit is not designed to express an opinion on the effectiveness of internal control, we often encounter weaknesses during our procedures that the entity needs to know about to protect its financial integrity.
Significant deficiency in internal control. Let us start with the technical definition of a deficiency in internal control. This occurs in two scenarios. First, when a control is designed, implemented, or operated in such a way that it is unable to prevent or detect and correct misstatements in the financial statements on a timely basis. Second, it occurs when a control that is actually necessary to prevent or detect misstatements is missing entirely.
The standard elevates certain issues to the level of a significant deficiency. This is a deficiency, or perhaps a combination of several deficiencies, that in your professional judgment is of sufficient importance to merit the attention of those charged with governance. It is not just about a single error, it is about a systemic weakness that could lead to material trouble. To determine if a deficiency is significant, you do not look at whether a misstatement has actually occurred, but rather the likelihood that a misstatement could occur and the potential magnitude of that misstatement.
To help you remember the factors you should consider when judging if a deficiency is significant, I want you to use the mnemonic LAMPL stands for the likelihood of the deficiency, leading to material misstatements in the future. A represents the susceptibility to loss or fraud of the related assets or liabilities. M is for the magnitude of the potential misstatement that might result. P stands for the professional judgment you must use to decide if the matter merits the attention of governance.
Communication to management. Let us look at the communication process itself. The standard is very clear about the format and the audience. For all significant deficiencies identified during the audit, you are required to communicate them in writing to those charged with governance on a timely basis. This formal written record ensures there is no misunderstanding about the severity of the risks. You also have a responsibility toward management. You must communicate the significant deficiencies to them in writing as well, unless you determine that doing so would be inappropriate in the circumstances, such as if the deficiency calls into question the integrity of management itself. Furthermore, you should communicate other deficiencies in internal control to management that have not been communicated by other parties, and that, in your judgment, are important enough to merit their attention. These other deficiencies do not strictly require a written format, but you must still ensure they are brought to management's notice.
In your written communication, you must include enough information for the recipients to understand the context. This includes a description of the deficiencies and an explanation of their potential effects. You must also include a specific disclaimer stating that the audit included consideration of internal control only to design appropriate audit procedures and not to express an opinion on the effectiveness of the control itself. Finally, you state that the matters being reported are limited to those deficiencies that the auditor identified during the audit. So, remember to keep your LAMP shining to identify those significant deficiencies that must be put in writing for governance.
Let us move on to Standard on Auditing 299, which focuses on the joint audit of financial statements. When an entity appoints 2 or more auditors to conduct an audit together, it is essential that they work in a synchronized manner to achieve the overall audit objectives.
Joint Audit Work Division, the first technical area we must address, is the division of work and the joint planning process. The standard requires that the engagement partner and other key members of the engagement team from each of the joint auditors must be actively involved in planning the audit. This is not a task for just one firm to handle alone. It is a collective effort from the very start. Together, the joint auditors are required to establish the overall audit strategy. This strategy is vital because it sets the scope, timing, and direction of the audit, and it serves as the primary foundation that guides the development of the detailed audit plan.
Prior to the actual commencement of the audit procedures, the joint auditors are mandated to discuss and develop a joint audit plan. A critical part of this plan is the allocation of work to be undertaken between the joint auditors. The logic here is to ensure that every significant area of the financial statements and every business component is covered without unnecessary duplication of effort, or, even worse, leaving a gap where a material misstatement could hide. This allocation should be clearly documented and agreed upon by all parties. To help you remember these initial steps for your exam, use the mnemonic JAP. J stands for the joint establishment of the overall strategy. O is for the allocation of work between the firms. P represents the joint audit plan that must be developed before starting. By following your JAP, you ensure that the groundwork for a professional joint audit is solid.
Joint and several responsibility. Moving on to the responsibility of joint auditors, the technical framework of this standard necessitates a clear understanding of who is liable for what. When work is specifically divided and allocated among the joint auditors, each auditor is primarily responsible for the audit procedures and findings related to the specific units or areas assigned to them. However, there are areas where you cannot simply point the finger at the other firm. All joint auditors share a joint and several responsibility for three specific things. First, they are responsible for audit work that is not divided among them and is performed by all of them. Second, they are responsible for the decisions taken by all the joint auditors under the joint audit plan regarding the nature, timing, and extent of audit procedures. Finally, they are jointly responsible for ensuring that the financial statements comply with the requirements of the relevant statutes and for the overall presentation of the financial statements.
Reporting by joint auditors. Finally, let us look at the reporting considerations for a joint audit. The goal is typically for the joint auditors to communicate their findings through a single, joint audit report expressing a common opinion. But what happens if you and the other firm simply cannot see eye to eye? The standard provides a professional safeguard. Joint auditors are not required to agree on the same opinion. If there is a genuine disagreement among you regarding the opinion to be expressed, or any specific matter to be included in the report, each auditor has the right to express their own opinion through a separate audit report. In these exceptional cases, the audit report issued by each auditor must include a reference to the report issued by the other joint auditor to provide full transparency to the shareholders and other stakeholders.
Let us step into the vital world of audit planning, governed by standard on Auditing 300. You must understand that planning is not a discrete phase of an audit, but rather a continual and iterative process that often begins shortly after the completion of the previous audit and continues until the completion of the current engagement. Overall audit strategy and plan. The logic behind SA 300 is to ensure the audit is conducted in an effective and efficient manner.
We start by establishing the overall audit strategy. Think of the strategy as the high-level roadmap. Technical knowledge tells us that the strategy sets the scope, timing, and direction of the audit. It guides the development of the more detailed audit plan. To help you remember what the strategy covers, think of the mnemonic STDRS stands for the scope of the audit, including the financial reporting framework. T is for the reporting objectives and timing of the audit. D represents the direction of the audit, which involves considering significant factors like materiality and high-risk areas. Finally, R stands for the nature, timing, and extent of resources necessary to perform the engagement.
Once the strategy is set, we develop the detailed audit plan. The plan is much more specific than the strategy. It includes a description of the nature, timing, and extent of planned risk assessment procedures under SA 315 and further audit procedures at the assertion level under SA 330. While the strategy gives you the vision, the plan gives you the specific tasks.
Documenting audit plan documentation is a mandatory requirement. The auditor must document three specific things. First, the overall audit strategy. Second, the audit plan. Third, any significant changes made during the audit engagement to the strategy or the plan and the reasons for those changes. The logic here is that documentation serves as a record of the proper planning of the audit that can be reviewed and understood by others, including engagement quality control reviewers.
Changes to planning. The standard emphasizes that planning is iterative. As the audit progresses, the auditor may need to modify the overall audit strategy and the audit plan. This usually happens because of unexpected events, changes in conditions, or the audit evidence obtained from performing audit procedures. For instance, if you perform a risk assessment and find that the internal controls are much weaker than you initially assumed, you cannot just stick to your old plan. You must iterate back, revise your strategy, and increase the extent of your substantive testing. Revision in audit program. This leads us to the revision in the audit program. An audit program is a detailed set of instructions to the engagement team. It must be flexible. If during the course of the audit you find that the procedures in your program are not yielding sufficient appropriate evidence, or if new risks come to light, the program must be revised. The auditor should not blindly follow a checklist, but should constantly use professional judgment to ensure the procedures remain responsive to the risks of material misstatement. So, remember to follow your SDDR roadmap for the strategy, but always be ready to iterate your plan as the evidence unfolds.
Let us transition to standard on auditing 315, which is one of the most critical standards for your exam. It deals with identifying and assessing the risks of material misstatement through understanding the entity and its environment. We will start with the fundamental building blocks of audit testing, which are assertions. Assertions, the logic behind assertions, is that management is essentially making a series of promises to the users of the financial statements. Technically, assertions are representations by management, explicit or otherwise, that are embodied in the financial statements, as used by the auditor to consider the different types of potential misstatements that may occur.
These relate to the recognition, measurement, presentation, and disclosure of the various elements, specifically the amounts and disclosures within those financial statements.
Picture this scenario. The management of a company like ABC Limited asserts to you that the sales balance in the accounting records contains all the sales transactions. This is the completeness assertion. They also assert that the transactions actually took place and are valid, which is the occurrence assertion. Furthermore, they represent that transactions have been properly recorded in the accounting records and in the appropriate accounting period, which involves the accuracy and cutoff assertions.
Standard on Auditing 315 categorizes assertions to help you consider potential misstatements systematically. The first category is assertions about classes of transactions and events for the period under audit. The second category relates to risks identifiable with specific assertions at the class of transactions, account balance, or disclosure level. This means that for each individual element, an assessment of risk, such as high, moderate, or low, should be made for each individual assertion being addressed.
To help you remember the specific assertions you must document, let us use the mnemonic CAVVPC stands for completeness. E is for existence, A stands for accuracy, the first V is for validity, the second V is for valuation, P stands for presentation. By documenting the impact of risk on each of these relevant assertions, you ensure your audit procedures are precisely targeted.
You must also realize that an error is not likely to be confined to a single assertion, such as the completeness of sales. It could easily relate to other assertions, such as accuracy, existence, and valuation. By understanding these assertions, you can identify those areas which are prone to misstatements, whether due to errors or frauds, ensuring an effective and qualitative audit.
Building on our understanding of assertions, we must now focus on identifying which of those assertions carry the highest degree of risk. These are technically known as significant risks, which the auditor identifies as part of the risk assessment process under Standard on Auditing 315. Risks that require special audit consideration. The logic behind identifying significant risks is that not all risks are created equal. Some risks require special audit consideration because of their nature or the magnitude of potential misstatement. When you are determining whether a risk is significant, you should exclude the effects of identified controls related to the risk. You are looking at the pure, raw risk first.
To help you remember the criteria for identifying significant risks for your exam, let us use the mnemonic CRAFTS first. C stands for the complexity of transactions. If a transaction is technically complex, such as the valuation of intricate derivative instruments, It is more likely to be misstated and often requires an auditor's expert. Second, R represents significant transactions with related parties. Because these transactions may not be at arm's length, they carry a higher risk of being used to manipulate financial results. Third, A stands for significant recent accounting, economic, or other developments. For example, if there is a major change in accounting standards like a new revenue recognition model, the first year of implementation carries a significant risk of error. Fourth, F is for fraud risk. The standards are very clear on this point. A risk of material misstatement due to fraud is always considered a significant risk. This is because fraud involves intentional deception and sophisticated schemes to hide the truth. Fifth, T represents significant transactions that are outside the normal course of business for the entity, or that otherwise appear to be unusual. These could include one-off asset disposals or major business acquisitions that do not happen every day. Finally, S stands for the degree of subjectivity in the measurement of financial information. This is particularly relevant for accounting estimates that have high estimation uncertainty or are based on subjective judgments by management.
You must also remember a critical technical point regarding management override of controls. Because of the unpredictable way management can bypass even the best internal controls, the risk of management override is always classified as a significant risk. To address these significant risks, the auditor is required to perform specific procedures. This involves evaluating the design of the entity's related controls and determining whether they have been implemented. If you identify a significant risk, you must also design and perform substantive procedures that are specifically responsive to that risk. This ensures that the areas of highest danger receive the most professional attention.
Let us dive into Standard on Auditing 320, which focuses on materiality in planning and performing an audit. The logic behind materiality is that not every single rupee matters to every user. As auditors, we need to determine what level of misstatement would actually influence the economic decisions of the users of the financial statements.
Use of benchmarks in determining materiality. When you are setting materiality for the financial statements as a whole, you start by choosing a benchmark. This serves as a starting point. There is no single rule for which benchmark to use, but technical guidance suggests several common ones. These include profit before tax, total revenue, gross profit, total expenses, total equity, or net asset value. The logic behind choosing a specific benchmark depends on the context of the entity.
To help you remember the factors you should consider when selecting a benchmark for your exam, let us use the mnemonic EUNOV first. E stands for the elements of the financial statements such as assets, liabilities, or equity. Second, U represents those items that users focus on. For example, if users are primarily interested in the company's profitability, profit before tax is often the best benchmark. Third, N is for the nature of the entity, where it is in its life cycle, and the industry and economic environment in which it operates. Fourth, O stands for the ownership structure and how the entity is financed. If an entity is financed solely by debt rather than equity, users may put more emphasis on assets and claims on them. Fifth, V is for the relative volatility of the benchmark. You want a stable starting point. So if profit before tax is highly volatile, you might look at a more stable benchmark like gross profit or total revenue.
Revision as audit progresses now. You must understand that materiality is not a static number determined only at the start of the audit. It is part of that iterative process we discussed earlier. The standard requires the auditor to revise materiality for the financial statements as a whole, or for specific classes of transactions, if you become aware of information during the audit that would have caused you to determine a different amount initially.
Picture this scenario. You initially set materiality based on estimated annual financial results because the year was not yet over. However, as the audit progresses and actual results become available, you notice a significant discrepancy. Perhaps actual sales were only 30% of the estimated figures due to an unexpected project slowdown. In this case, the logic dictates that you must review and reassess your initial materiality level. If your reassessment results in a lower materiality amount than you initially calculated, you have specific technical duties. You must determine whether it is necessary to revise performance materiality and whether the nature, timing, and extent of your planned further audit procedures remain appropriate. If the goalpost has moved closer because materiality is now lower, your procedures might need to be more rigorous to catch smaller errors.
So remember to use your EUNOV factors to pick your benchmark, but keep a cold eye on the actual results so you can revise your plan if the financial ICE melts. I stands for information awareness. C is for change in circumstances. E is for expected versus actual results.
Let us move forward to standard on auditing 330, which is all about the auditor's responses to assessed risks. We will start with our first logical subtopic, which is tests of controls and their operating effectiveness. Tests of controls and operating effectiveness, the logic behind this part of the standard, is simple if you plan to rely on a company's internal rules and systems to prevent errors. You first have to prove that those rules actually work.
Technically, tests of controls, often called TOC, are procedures designed to evaluate the operating effectiveness of controls in preventing or detecting and correcting material misstatements at the assertion level.
You are required to perform these tests in two specific scenarios. First, when your risk assessment includes an expectation that the controls are operating effectively. This is when you decide to trust the system so you can do less heavy lifting later with your detailed testing. Second, you must perform tests of controls when substantive procedures alone simply cannot provide enough evidence. Picture an entity with a highly automated system where transactions leave no manual trail. In that case, you have no choice but to test the system itself.
To help you remember what to look for when you are testing these controls, let us use the mnemonic ACA stands for by whom and how the controls were applied. C represents the consistency with which they were applied throughout the period. E stands for the evidence of the control's operating effectiveness. When you are performing these tests, you are not just checking if a rule exists, but how it was carried out. You need to consider if the person performing the control was competent, and if they did it every single time as required.
If you find deviations or mistakes during your testing, you cannot just ignore them. You must investigate the cause through specific inquiries. Perhaps there was a change in key personnel or a huge seasonal spike in transactions that overwhelmed the staff. These deviations might force you to revise your assessment of control risk. If the system is broken, you have to do more detailed, substantive work to get the assurance you need. Remember a key technical principle: the more reliance you intend to place on a control, the more persuasive the evidence you need to gather. You cannot rely on a critical system based on a single observation. You need a pattern of success.
Let us move to the other half of our response to assessed risks, which is performing substantive procedures under standard on auditing 330. While tests of controls look at the system, substantive procedures look directly at the numbers to detect material misstatements at the assertion level.
Substantive procedures, the logic here is that internal controls are never perfect. No matter how much you trust the entity's systems, you are technically required to perform substantive procedures for each material class of transactions, account balance, and disclosure. This is a mandatory safety net. You cannot rely on controls alone for items that are significant to the financial statements.
Substantive procedures are divided into two main types. First, tests of details, which involve checking individual transactions and balances against supporting documents. Second, substantive analytical procedures, where you use relationships between data to identify potential errors.
To help you remember the scope of these procedures for your exam, let us use the mnemonic SDARSS stands for every single material item. Even if risk is assessed as low, you must test material areas. T is for tests of details, our deep dive into the individual transactions. A represents substantive analytical procedures, our high-level look at data trends and expectations. R is for reconciling the financial statements with the underlying accounting records, which is a required procedure for every audit. S stands for significant risks. If you have identified a significant risk, such as the risk of fraud or management override, your substantive procedures must be specifically designed to respond to that exact danger.
A technical requirement you must remember involves the financial statement closing process. You are required to perform procedures to agree or reconcile the financial statements with the underlying accounting records. You must also examine material journal entries and other adjustments made during the preparation of the statements. This ensures that the final output accurately reflects the ledger.
Finally, consider the element of unpredictability. For high-risk areas, you should perform substantive procedures that are not expected by the client. This might mean changing the timing of your tests or selecting items that are below your usual materiality threshold. By keeping your procedures unpredictable, you make it much harder for anyone to hide fraudulent financial reporting.
Let us turn our attention to Standard on Auditing 402. This standard is crucial when the company you are auditing outsources some of its functions, such as payroll processing or data storage, to an outside service organization. As the user auditor, you cannot simply ignore these outsourced functions. You must understand how they affect the entity's internal control environment.
Risk assessment procedures for user entity, the logic here is that the service organization's activities are actually part of the user entity's information system. Therefore, you are required to obtain an understanding of how the user entity uses the services of a service organization. This is part of your risk assessment procedures under Standard on Auditing 315. First, you must understand the nature of the services provided and how significant they are to the user entity, specifically their effect on the user entity's internal control.
The second point is to look at the nature and materiality of the transactions processed or the financial reporting processes affected by those services. Third, you must evaluate the degree of interaction between the activities of the service organization and those of the user entity. For example, if the user entity maintains high control over the data sent and received, the risk might be lower. Finally, you must understand the nature of the relationship, including the relevant contractual terms for the activities undertaken. To help you remember these initial assessment factors, use the mnemonic DIRTD, stands for the description and nature of the services. I represents the degree of interaction between the two entities. R is for the relationship and contractual terms. T stands for the materiality of the transactions processed.
Tests of controls. If your risk assessment indicates that you need to rely on the operating effectiveness of controls at the service organization, you must obtain evidence about those controls. Technically, you have a few options here. You can obtain a Type 1 or Type 2 report from the service auditor. A Type 1 report focuses on the description and design of the controls at a specific date. A Type 2 report is much more valuable because it also includes the service auditor's opinion on the operating effectiveness of those controls over a period of time.
When you are evaluating a service auditor's report, you must consider three things. First, evaluate whether the description and design of controls are at a date or for a period appropriate for your audit purposes. Second, evaluate the sufficiency and appropriateness of the evidence provided by the report for understanding the user entity's internal control. Third, determine whether any complementary user entity controls identified by the service organization are relevant and if the user entity has actually implemented them. If you are using a Type 2 report as evidence of operating effectiveness, you must also evaluate the adequacy of the time period covered by the tests and the time elapsed since the performance of those tests. You must decide if the results are relevant to the assertions in the user entity's financial statements and provide enough evidence to support your risk assessment.
Reporting by user auditor. Finally, let us look at your reporting responsibilities. The standard is very strict here. If you are unable to obtain sufficient appropriate audit evidence regarding the services provided by the service organization, you are required to express a modified opinion in your audit report. However, there is a key technical rule for unmodified opinions. If you are expressing an unmodified opinion, you must not refer to the work of the service auditor in your report. The logic is that you, as the user auditor, have sole responsibility for the audit opinion, and referring to the service auditor might mislead users into thinking that responsibility is shared.
You only refer to the service auditor's work if it is required by law or regulation, or if such a reference is necessary to explain a modification to your opinion. Even then, you must clearly state that such a reference does not diminish your own responsibility for that opinion.
Let us turn our attention to Standard on Auditing 450. This standard deals with how you evaluate the misstatements you have found during your audit. Think of this as the final check where you decide what actually matters to the stakeholders. Revision of audit strategy. First, we must understand what a misstatement actually is. Technically, it is the difference between the amount, classification, presentation, or disclosure of a reported financial statement item and what is required by the financial reporting framework. These can arise from either error or fraud.
As you go through your audit, you are required to accumulate all these identified misstatements, but with one important exception, you do not need to record those that are clearly trivial. Now, be careful here because the exam loves this point. Clearly trivial is not just another way of saying not material. These are misstatements of a much smaller order of magnitude that are clearly inconsequential, whether you look at them individually or in the aggregate.
To help you organize these findings, the standard distinguishes between three categories. First, factual misstatements where there is absolutely no doubt. Second, judgmental misstatements which come from differences in management's judgments concerning accounting estimates or the selection of policies that you consider inappropriate. Third, projected misstatements, which are your best estimates of misstatements in entire populations based on what you found in your samples.
The logic here is that as you accumulate these errors, you might realize your initial plan was too optimistic. You are required to determine whether your overall audit strategy and audit plan need to be revised. This is especially true if the aggregate of misstatements you have found starts to approach your materiality level. A very important technical step you must remember for the exam is that before you evaluate the effect of uncorrected misstatements, you must reassess materiality under Standard on Auditing 320. Since your initial materiality was likely based on estimated results, you now need to confirm it is still appropriate in light of the entity's actual financial results. If actual sales or profits were much lower than your estimates, your materiality threshold might need to drop, which means you might have to perform more audit work.
Communication and correction of misstatements. Moving on to your duties of communication. You are required to communicate all accumulated misstatements to the appropriate level of management on a timely basis, unless prohibited by law, and request that they correct them. The logic is to give the company the chance to present accurate numbers. If management actually examines the accounts and makes the corrections, your job isn't quite done. You must perform additional audit procedures to determine whether any misstatements still remain.
But what if management refuses to fix them? If management refuses to correct some or all of the misstatements you have pointed out, you must obtain an understanding of their reasons for not making the corrections. You then take that understanding into account when you are evaluating whether the financial statements as a whole are free from material misstatement. Their refusal might give you critical insights into management integrity or potential bias.
Written representation to provide a final layer of evidence. You are required to obtain a written representation from management and, where appropriate, those charged with governance. In this document, they must acknowledge whether they believe the effects of the uncorrected misstatements are immaterial, both individually and in the aggregate, to the financial statements as a whole. You should include a summary of these uncorrected items within or attached to the representation letter, so there is no ambiguity about what they are confirming.
Finally, let us look at the documentation requirements. To satisfy the standard, you must record 3 specific elements. First, the amount below which you consider misstatements to be clearly trivial. Second, a list of all misstatements accumulated during the audit, and a note on whether they have been corrected. Third, your final conclusion as to whether the uncorrected misstatements are material and the professional basis for that conclusion.
To help you remember the core of SA 450, think of the mnemonic CARE. SAY stands for the communication of all misstatements to management. A is for the accumulation of misstatements except for the trivial ones. R represents the revision of the audit strategy and reassessment of materiality. E is for the final evaluation and obtaining the written representations. By following the CARE steps, you ensure that no material error goes unnoticed before you sign that report.
Let us transition into the 500 series, starting with the cornerstone of all our work standard on Auditing 500, which governs audit evidence. This standard is applicable to all the audit evidence obtained during the entire course of an audit. The primary objective is to design and perform audit procedures in such a way as to enable the auditor to obtain sufficient appropriate audit evidence to be able to draw reasonable conclusions on which to base the auditor's opinion.
Sufficiency and appropriateness of audit evidence. The logic here is that your evidence must meet 2 specific criteria: sufficiency and appropriateness. Sufficiency is the measure of the quantity of audit evidence. Appropriateness is the measure of the quality of audit evidence. This quality is determined by the relevance of the evidence and its reliability in providing support for the conclusions on which you base your opinion.
It is important to remember that audit evidence is a broad concept that includes both the information contained in the accounting records that underlie the financial statements and any other information you obtain during the audit. There is a dynamic relationship between quantity and quality. The quantity of evidence needed is affected by your assessment of the risks of material misstatement and also by the quality of the evidence itself. This means that the higher the assessed risks, the more audit evidence you will likely need to gather. Similarly, the higher the quality of your evidence, the less quantity may be required. However, you must always keep in mind that simply obtaining more audit evidence may not compensate for evidence that is of poor quality.
To gather this evidence, you must perform risk assessment procedures and further audit procedures. These further audit procedures consist of tests of controls and substantive procedures, which include tests of details and substantive analytical procedures. When you are using information that has been produced by the entity itself, you are required to evaluate the reliability, completeness, and accuracy of that information to ensure it is suitable for your purposes.
If you ever find that evidence obtained from one source is inconsistent with that obtained from another, or if you have doubts about the reliability of the information, you must take action. You are required to determine what modifications or additions to your audit procedures are necessary to resolve the issue. Finally, you must consider the effect of these inconsistencies or doubts on all other aspects of the audit. To help you remember this relationship for your exam, use the mnemonic QQR, where quantity and quality are always responsive to the level of risk you identify.
Let us focus on the two pillars that support the quality of your evidence, which are relevance and reliability. This is the technical definition of the appropriateness side of the evidence equation. Relevance and reliability first. Let us look at relevance. Technically, relevance deals with the logical connection with, or bearing upon, the purpose of the audit procedure, and where appropriate, the assertion you are currently considering.
Think of it as the direction of your work. The relevance of your information may be affected by the direction of testing. Picture this scenario where you are testing for the overstatement of accounts payable. In this case, performing a test on the recorded entries in the ledger is highly relevant. However, if your objective is to test for the understatement of accounts payable, testing the already recorded entries is not relevant. Instead, you would need to look at things like subsequent payments, unpaid invoices, or suppliers' statements to see what has been omitted. You must also realize that a single set of procedures may provide evidence that is relevant to certain assertions, like the existence of inventory, but not to others, such as its final valuation or who actually owns it.
The second pillar is reliability. The logic here is that the source and the nature of the information directly impact how much professional trust you can place in it. While reliability is influenced by its source, it also depends heavily on the specific circumstances under which that evidence was obtained.
To help you judge reliability for your exam, I want you to use the mnemonic DICE to roll for reliability. D stands for evidence obtained directly by you. Evidence obtained directly by the auditor, such as by observing a control, is more reliable than evidence obtained indirectly or by inference. I represents information from independent outside sources. Audit evidence is generally more reliable when it is obtained from independent sources outside the entity. C is for the effectiveness of internal controls. Evidence is more reliable when the internal controls over its preparation and maintenance are effective. E stands for evidence in documentary form. Evidence in documentary form, whether paper or electronic, is more reliable than evidence obtained orally. By checking your DICE, you ensure that the evidence you gather is truly appropriate to support your audit opinion.
Now we move on to a critical aspect of our evidence gathering process, which involves situations where management uses specialists to help them prepare the financial statements. This is governed by the technical requirements for a management expert under Standard on Auditing 500. Management expert. A management expert is defined as an individual or organization possessing expertise in a field other than accounting or auditing, whose work in that field is used by the entity to assist in preparing the financial statements.
The logic here is that modern business often requires specialized knowledge that accountants simply do not have. such as valuing complex real estate, calculating actuarial liabilities for pensions, or estimating oil and gas reserves.
When management relies on such an expert, the standard is very clear that we as auditors cannot just accept their work at face value. We have a professional duty to verify that this evidence is reliable. To do this, we are required to perform 3 specific procedures.
First, we must evaluate the competence, capabilities, and objectivity of that expert. This involves looking at their professional certifications, their reputation in the market, and checking if they have any financial interests or relationships with the client that might cloud their judgment. We need to be sure they are both good at what they do and independent enough to do it honestly.
Second, we must obtain an understanding of the work of that expert. We need to dive into their specific field of expertise and understand the methods and assumptions they used. We also need to understand the scope and objectives of their engagement with management to ensure it covers the areas we are interested in for our audit.
Third, we must evaluate the appropriateness of that expert's work as audit evidence for the relevant assertion. We look at the findings and conclusions of the expert and check if they are reasonable and consistent with other audit evidence we have obtained. We also evaluate whether the source data used by the expert was sufficient, reliable, and relevant to the task.
To help you remember these 3 essential duties for your exam, let us use the mnemonic CUEC stands for checking the expert's competence, capabilities, and objectivity. U represents obtaining a thorough understanding of their work in their field. E is for evaluating the appropriateness of their work as audit evidence. By using your CUE, you fulfill your professional skepticism and ensure that the specialist work you rely on is a solid foundation for your audit opinion. This information is based on the general technical requirements of the standard as part of the CA Final Auditing Framework.
Let us move forward to standard on auditing 501. This standard is not a general one like SA 500 instead. It deals with specific considerations for obtaining sufficient appropriate audit evidence regarding selected items. In our session today, we will focus on the 2 areas designated in our syllabus: inventory and litigation.
Inventory and physical counting. The logic behind this standard is that for many businesses, inventory is a significant item on the balance sheet. Therefore, the auditor has a specific objective to obtain sufficient appropriate audit evidence regarding 2 things: the existence of the inventory and its physical condition. Technically, if inventory is material to the financial statements, the auditor is required to obtain this evidence by attending the entity's physical inventory counting, unless it is simply impracticable to do so.
This attendance is not just about being a passive bystander. The standard mandates that you perform 4 specific procedures during the count. To help you remember these for your exam, let us use the mnemonic IOPI first. I stands for evaluating management's instructions and procedures for recording and controlling the results of the physical inventory counting. You need to ensure their plan is sound before they even start. Second, O represents observing the performance of management's count procedures. This helps you confirm that the staff are actually following those instructions you just evaluated. Third, P is for performing test counts. You take a sample of items from the floor and trace them to the count sheets, and then do the reverse, tracing from the sheets back to the actual stock. Finally, the second I stands for inspecting the inventory. While you are there, you are looking for more than just quantity. You are looking for the condition of the items to see if any are damaged or obsolete, which affects their valuation.
Now picture this scenario. What if the company does not count its stock on the exact date of the financial statements? Sometimes they count a few days before or after the year end. In such cases, the standard requires you to perform additional audit procedures to obtain evidence about whether changes in inventory between the count date and the date of the financial statements are properly recorded. What if attendance is totally impracticable due to unforeseen circumstances, like a natural disaster or a strike at a warehouse location? In that case, you must perform alternative audit procedures to obtain sufficient appropriate audit evidence regarding the existence and condition of the inventory. This might involve inspecting documentation of the subsequent sale of specific inventory items acquired or purchased prior to the physical inventory counting. If it is still not possible to do so, you must modify your opinion in the audit report in accordance with SA 705 due to a limitation on the scope of your audit. Remember, keep your IOPI eyes open whenever you are on the warehouse floor to ensure that every box is accounted for.
Let us consider a different logistical challenge. What if the entity's inventory is not in its own warehouse, but is under the custody and control of a third party? This is quite common in modern supply chains, where companies use public warehouses or consignment agents. If this inventory is material to the financial statements, Standard on Auditing 501 requires you to obtain sufficient appropriate audit evidence regarding its existence and condition.
The standard gives you a few specific tools for this situation. The first is to request a direct confirmation from that third party regarding the quantities and the condition of the inventory they are holding on behalf of your client. The second is to perform an inspection or other audit procedures that are appropriate in the circumstances.
To help you remember the range of procedures you might use for third-party stock for your exam, let us use the mnemonic RIDER, stands for obtaining another auditor's report, or a service auditor's report. This is to gain assurance about the adequacy of the third party's internal controls for ensuring that the inventory is properly counted and adequately safeguarded. I is for performing an actual inspection of the inventory, if you can gain access to that third party's location. D represents inspecting documentation regarding the inventory held by third parties, such as warehouse receipts. E stands for requesting direct external confirmation from the third party as to the quantities and condition.
By taking this RIDE, you ensure that inventory held by others is just as verified as the stock on the client's own shelves. This is a vital step because out of sight should never mean out of mind for a professional auditor.
Litigation and claims, the logic behind this section of Standard on Auditing 501 is that pending lawsuits can significantly drain an entity's resources and often involve material liabilities that are not as easy to count as stock in a warehouse. Therefore, the auditor has a specific objective to obtain sufficient appropriate audit evidence regarding the completeness of litigation and claims involving the entity.
To identify these hidden legal threats, you are required to perform 3 mandatory audit procedures. First, you must make inquiries of management and, where applicable, others within the entity, such as in-house legal counsel. The second step is to review the minutes of meetings of those charged with governance and correspondence between the entity and its external legal counsel. Third, you must review legal expense accounts to see which lawyers are being paid and for what. To help you remember these initial identification steps, use the mnemonic MMLM stands for inquiring of management. The second M is for reviewing minutes of meetings. L is for checking the legal expense accounts.
Legal counsel communication now. If your initial procedures under MML lead you to assess a risk of material misstatement, or if you find that material litigation actually exists, the standard requires you to go directly to the source. You must seek direct communication with the entity's external legal counsel. Technically, you do this through a letter of inquiry that is prepared by management and sent by you as the auditor, requesting the lawyer to communicate directly with you. The standard allows for a letter of specific inquiry, which provides the lawyer with a list of litigation and claims identified by management. This letter asks the external legal counsel to confirm the reasonableness of management's assessments and provide you with further information if the list is considered incomplete or incorrect.
You might even seek a meeting with the external legal counsel if the matter involves a significant risk, if it is highly complex, or if there is a disagreement between management and the lawyer. Picture this scenario where the lawyer refuses to comment or management refuses to let you talk to them. If management refuses to give you permission to communicate with the lawyer, or if the lawyer refuses to respond and you cannot obtain evidence through alternative procedures, the logic is clear: you have a scope limitation. In such cases, you are required to modify your opinion in the audit report in accordance with Standard on Auditing 705.
Finally, you must obtain a written representation from management and those charged with governance. In this document, they must state that all known actual or possible litigations and claims whose effects should be considered have been disclosed to you and appropriately accounted for and disclosed in accordance with the applicable financial reporting framework. This provides the final professional seal on your work regarding legal liabilities.
Let us move forward to Standard on Auditing 505, which deals with external confirmations. The logic behind this standard is that audit evidence is generally more reliable when it is obtained from independent sources outside the audited entity. Technically, an external confirmation is audit evidence obtained as a direct written response to the auditor from a third party, which we call the confirming party. This response can be in paper form, electronic, or any other medium.
External confirmation procedures. When you decide to use external confirmation procedures, the standard requires you to maintain control over the entire process. You cannot let the client's staff handle the correspondence, as that would defeat the purpose of seeking independent evidence. Technically, there are 4 specific steps you must follow to maintain this control. First, you must determine the information to be confirmed or requested. This usually involves balances of accounts receivable or payable, but it can also include the terms of agreements or the absence of certain conditions, like side agreements. Second, you must select the appropriate confirming party. You want to send the request to someone who is knowledgeable about the information being confirmed. Third, you must design the confirmation requests. This includes ensuring they are properly addressed and contain return information for responses to be sent directly to you. Finally, you must send the request yourself, including follow-up requests where applicable. To help you remember these 4 steps for your exam, let us use the mnemonic DSDSD stands for determining the information. S represents selecting the confirming party. D is for designing the request. S stands for sending the requests and follow-ups. Just remember to follow your DSDS to ensure the confirmation process is under your professional control.
Management refusal. Now, picture this scenario. You have identified a high-risk debtor and want to send a confirmation, but management says no. If management refuses to allow you to send a confirmation request, you cannot just accept their word. The standard requires you to take 3 specific actions. First, you must inquire as to management's reasons for the refusal and seek audit evidence as to their validity and reasonableness. Sometimes they have a legitimate reason, such as a sensitive legal dispute with that specific party. Second, you must evaluate the implications of their refusal on your assessment of the relevant risks of material misstatement, including the risk of fraud. Does this refusal signal that they are trying to hide a fake balance? Third, you must perform alternative audit procedures designed to obtain relevant and reliable audit evidence. For a debtor, this might involve checking subsequent cash receipts or shipping documents. If you conclude that management's refusal is unreasonable, or if you are unable to obtain relevant and reliable audit evidence from alternative procedures, you are required to communicate with those charged with governance. You must also determine the implications for the audit and your final audit opinion in accordance with Standard on Auditing 705. To help you remember your response to a refusal, use the mnemonic IEA. I stands for inquiring into the reasons. E is for evaluating the risk implications. A represents performing alternative procedures. By following your IEA, you ensure that a management no does not become a hole in your audit evidence.
If you conclude that management's refusal is unreasonable, or if you are unable to obtain relevant and reliable audit evidence from alternative procedures, you are required to communicate with those charged with governance. You must also determine the implications for the audit and your final audit opinion in accordance with Standard on Auditing 705. To help you remember your response to a refusal, use the mnemonic IEA. I stands for inquiring into the reasons. E is for evaluating the risk implications. A represents performing alternative procedures. By following your IEA, you ensure that a management no does not become a hole in your audit evidence.
Let us conclude our discussion on Standard on Auditing 505 by examining the different types of confirmation requests and how we handle situations where we hear nothing back. Positive confirmation, the logic behind choosing the type of request, is based on the level of assurance you need to obtain. Technically, a positive confirmation request asks the confirming party to respond directly to the auditor in all cases, indicating whether they agree or disagree with the information provided, or by providing the requested information itself. This is considered highly reliable because a response provides a clear, active confirmation of the data. In contrast, you may also use negative confirmation requests. This is a request that the confirming party respond directly to the auditor only if they disagree with the information provided. The technical guidance is very clear that negative confirmations provide less persuasive audit evidence than positive confirmations. The logic is simple: the failure to receive a response to a negative confirmation request does not explicitly indicate that the confirming party received the request or even verified the information. They might have simply ignored it, or it might have been lost in the mail.
Non-response. Let us consider the technical scenario of a non-response. This occurs when the auditor does not receive a reply to a positive confirmation request, or when a request is returned undelivered. If you encounter a non-response, you are required to perform alternative audit procedures to obtain relevant and reliable audit evidence. For example, if a customer does not respond to a confirmation of their balance, your alternative procedures might include examining specific subsequent cash receipts to see if they paid the bill after the year end. You might also inspect shipping documentation and sales invoices to verify that the original transaction actually took place. For accounts payable, you could look at subsequent cash disbursements or statements from the suppliers themselves.
To help you remember your confirmation strategy for the exam, use the mnemonic PAN. PAY stands for positive requests, which provide the most persuasive evidence because a response is required in all cases. A represents alternative procedures, which are your mandatory backup plan whenever you have a non-response. N is for negative requests, which you should use with caution because they only signal disagreement. By following your PAN strategy, you ensure that the evidence you get from outside parties is both reliable and complete.
Now we move to Standard on Auditing 510, which deals with initial audit engagements and opening balances. The logic here is that as a new auditor, you were not there to check the numbers last year, but those numbers form the starting point for this year. If the foundation is shaky, the whole house might fall down. Opening balances, technically, an initial audit engagement is one where either the financial statements for the prior period were not audited at all, or they were audited by a predecessor auditor. Your objective is to obtain sufficient appropriate audit evidence regarding whether those opening balances contain misstatements that materially affect the current period's financial statements.
To help you remember your mandatory procedures for opening balances for the exam, let us use the mnemonic BRAP first. B stands for checking if the prior period's closing balances have been correctly brought forward to the current period. Second, R is for reading the most recent financial statements and the predecessor auditor's report, if there was one, for any information relevant to the opening balances. Third, A stands for performing specific audit procedures on the opening balances themselves. For example, for a current asset like inventory, you might observe a current physical count and reconcile it back to the beginning of the year. For non-current assets and liabilities, you might examine the records underlying the opening balances. Finally, P is for ensuring that the opening balances reflect appropriate accounting policies and that these policies have been applied consistently in the current period.
Consistency of accounting policies, the logic behind checking consistency, is to prevent management from manipulating results. If a company changes its method of valuing inventory or calculating depreciation just to make the current year look better, and does not disclose it, the financial statements are misleading. You must obtain evidence that policies are consistent, and if they have changed, that the change is properly accounted for, presented, and disclosed in accordance with the applicable financial reporting framework.
Communication with those charged with governance TCWG if your procedures lead you to conclude that the opening balances contain misstatements that materially affect the current period's financial statements, you have a technical duty of communication. You are required to inform management and those charged with governance on a timely basis. This gives them the opportunity to make the necessary corrections before the current audit is finalized. Reporting finally, let us look at the implications for your audit report. There are three main technical scenarios you should be prepared for. First, if you are simply unable to obtain sufficient appropriate audit evidence regarding the opening balances, the logic is that you have a scope limitation. Therefore, you must express a qualified opinion or a disclaimer of opinion. Second, if you conclude that the opening balances actually contain a misstatement that materially affects the current financial statements, and it is not properly accounted for or disclosed, you express a qualified or an adverse opinion. Third, if you find that the accounting policies are not consistently applied, or that a change in policy is not properly handled, you also express a qualified or an adverse opinion. One more important technical detail: for the exam, if the predecessor auditor's report was modified, you must evaluate the matter that gave rise to that modification. If it is still relevant and material to the current period's financial statements, you must modify your own report to reflect this ongoing issue. So, remember to use your BRAP procedures to ensure the financial foundation is solid before you build your current year's opinion.
Let us advance to standard on auditing 520, which is dedicated to analytical procedures. While we have touched on these as risk assessment tools, this standard focuses on their use as substantive procedures to detect material misstatements at the assertion level. The logic here is that relationships among data exist and continue in the absence of known conditions to the contrary.
Analytical procedures as substantive tests. When you design and perform substantive analytical procedures, you are required to follow a specific technical sequence. First, you must determine the suitability of particular analytical procedures for given assertions. Not all assertions are best tested this way. For example, analytical procedures might be very effective for testing the accuracy of interest expense, but less effective for testing the valuation of complex legal contingencies. Second, you must evaluate the reliability of the data from which your expectation is developed. Technical guidance requires you to consider the source, comparability, and nature of the information available, as well as the controls over its preparation. If the data you start with is garbage, your conclusion will be garbage too.
Third, you must develop an expectation of recorded amounts or ratios and evaluate whether that expectation is sufficiently precise to identify a misstatement. This is the heart of the procedure. You are essentially saying, based on the data, I expect the balance to be X finally. You must determine the amount of any difference from that expectation that is acceptable without further investigation. This threshold must be influenced by materiality and the desired level of assurance. To help you remember these 4 steps for your exam, use the mnemonic SREDS stands for the suitability of the procedure for the assertion. R represents the reliability of the underlying data. E is for developing the expectation. D stands for determining the acceptable difference.
Techniques: trend, ratio, reasonableness, structural modeling. Let us look at the 4 specific techniques you can use to perform these procedures. The first is trend analysis. This involves looking at changes in an account balance over time. For example, comparing the monthly sales of the current year with the monthly sales of the previous year to identify any unusual spikes or dips that do not match the business cycle. The second is ratio analysis. This involves studying the relationship between different financial statement items, like the gross profit margin, or between financial and non-financial data, such as sales per square foot of retail space.
The third is the reasonableness test. This is a more sophisticated technique where you use a model to predict an account balance based on known variables. Picture this scenario where you calculate the expected interest income for the year by taking the average loan balance and multiplying it by the average interest rate. If your calculation is close to the recorded amount, you have gained substantive evidence. The fourth is structural modeling. This involves using statistical tools, such as regression analysis, to model the relationships between different variables. It is the most precise and complex of the 4 techniques.
Finally, you must understand your duty when you find a discrepancy. If your analytical procedures identify fluctuations or relationships that are inconsistent with other information, or that differ from your expectation by a significant amount, you are required to investigate. This involves 2 steps: inquiring of management and obtaining appropriate audit evidence relevant to their responses, and performing other audit procedures as necessary. You cannot just accept management's explanation at face value, you must verify it. So, remember to follow your SRED steps and choose the right technique from your toolkit to ensure your substantive testing is both efficient and robust.
Let us transition to Standard on Auditing 530, which governs the technical world of audit sampling. The logic behind this standard is one of professional efficiency. In a complex business environment, it is often impossible and unnecessary to check every single transaction. Therefore, we use sampling to provide a reasonable basis for our conclusions about an entire population.
Sampling risk. Technically, audit sampling is defined as the application of audit procedures to less than 100% of items within a population of audit relevance. A critical requirement is that all sampling units in that population must have a chance of selection. This process introduces what we call sampling risk. This is the risk that the auditor's conclusion based on a sample may be different from the conclusion that would have been reached if the entire population had been subjected to the same audit procedure.
Sampling risk can lead to 2 types of erroneous conclusions. The first type is when the auditor concludes that internal controls are more effective than they actually are, or that a material misstatement does not exist when it actually does. This is the most dangerous scenario because it directly affects audit effectiveness and is highly likely to lead to an inappropriate audit opinion. The second type is when the auditor concludes that controls are less effective than they are, or that a material misstatement exists when it actually does not. While this type of error primarily affects audit efficiency because it leads to additional work to establish that the initial conclusions were incorrect, it is still a significant professional risk.
You must distinguish this from non-sampling risk. This is the risk that the auditor reaches an erroneous conclusion for any reason not related to sampling risk. Examples of this include using inappropriate audit procedures, misinterpreting the evidence you have gathered, or simply failing to recognize a misstatement or a deviation when it is right in front of you.
Selection methods. To ensure that every unit has a chance of selection, you must use appropriate selection methods. While there are many techniques, we focus on 4 primary methods for your exam. First is random selection, which often uses random number generators to ensure every item has an equal probability of being picked. Second is systematic selection, where the auditor calculates a sampling interval and then picks every nth item after a random start. Third is haphazard selection, where the auditor selects the sample without following a structured technique, but must still avoid any conscious bias or predictability. Finally, there is block selection, which involves selecting a group of contiguous items from within the population. However, block selection is generally not recommended for audit sampling because it rarely provides a representative sample of the entire population.
Projecting misstatements. After you have performed your audit procedures on each item in the sample, you have a technical duty regarding any errors you found. For tests of details, the standard requires the auditor to project the misstatements found in the sample to the entire population. This gives you a statistically valid estimate of the total misstatement in that account balance or class of transactions. If you identify a deviation that you believe is an anomaly, you must perform additional audit procedures to obtain a high degree of certainty that it is not representative of the population. Evaluating results. The final logical step is evaluating the results of the sample. You must determine whether the use of audit sampling has provided a reasonable basis for your conclusions about the population. If you conclude that the results do not provide a reasonable basis, you have specific technical actions to take.
First, you can request management to investigate the misstatements that have been identified and the potential for further misstatements, asking them to make any necessary adjustments to the financial statements. Second, you must tailor the nature, timing, and extent of your further audit procedures to best achieve the required assurance. For example, in a test of controls, you might decide to extend the sample size, test an alternative control, or modify your related substantive procedures.
To help you remember the life cycle of a sample for your exam, use the mnemonic DSBED is for designing the audit sample while considering the purpose and the characteristics of the population. S stands for selecting the items, so every sampling unit has a chance of selection. P represents performing the appropriate audit procedures on each item selected. E is for evaluating the results, projecting misstatements, and deciding if you have a reasonable basis for your conclusion. By following your DSB steps, you ensure that your selective testing is both mathematically sound and professionally defensible.
Let us move on to Standard on Auditing 540, which deals with auditing accounting estimates, including fair value accounting estimates and related disclosures. This is a vital area because many financial statement items cannot be measured precisely, but can only be estimated. Technically, An accounting estimate is defined as an approximation of a monetary amount in the absence of a precise means of measurement. This term covers both fair value measurements and other amounts requiring estimation. The logic here is that business is full of inherent uncertainties, and the auditor needs a structured way to evaluate management's judgments.
Risk assessment procedures for accounting estimates. The first technical step is performing risk assessment procedures to provide a basis for identifying and assessing the risks of material misstatement for accounting estimates. You are required to obtain an understanding of three key areas. First, the requirements of the applicable financial reporting framework relevant to accounting estimates, including related disclosures. You need to know what the rules specifically say about how these numbers should be calculated and presented.
The second area is how management identifies those transactions, events, and conditions that may give rise to the need for accounting estimates to be recognized or disclosed. Management has the primary responsibility to ensure all necessary estimates have been properly captured in the financial statements. To help you remember the types of changes in circumstances you should inquire about when identifying these estimates, let us use the mnemonic NTCN is for new types of transactions that the entity has engaged in. T stands for changes in the terms of transactions that originally gave rise to estimates. E is for new events or conditions that have occurred. C stands for changes in accounting policies relating to estimates, and represents regulatory or other changes outside management's control that require revision. By following your NTEC check, you can determine if management has identified all the circumstances requiring a new or revised accounting estimate.
The third area of understanding is the most detailed how management actually makes the accounting estimates and an understanding of the data on which they are based. This is where you dive into their internal estimation process. To help you remember the 6 essential elements of this making process for your exam, let us use the mnemonic MUSECPM stands for the method, including where applicable the model, used in making the estimate. U represents whether and how management has assessed the effect of estimation uncertainty. S is for whether management has used a specialist or expert to assist them. E stands for the underlying assumptions used in the calculation. C is for the relevant internal controls over the estimation process. P is for whether there has been or ought to have been a change from the prior period in the methods used, and the reasons why.
You must remember that the degree of estimation uncertainty varies widely and directly affects the risks of material misstatement. While routine estimates like allowance for doubtful accounts, inventory obsolescence, or depreciation methods have lower uncertainty, high estimation uncertainty areas, such as the outcome of litigation or complex derivative financial instruments, often give rise to significant risks that require special audit attention. By following your MUSECP check, you ensure your understanding of the entity's estimation process is complete and professional.
Now, once you have identified and assessed those risks, we must decide how to respond. Under Standard on Auditing 540, your response must be precisely tailored to the level of risk you found. The logic is that you must first determine if management has appropriately applied the requirements of the financial reporting framework, and if their methods for making estimates are appropriate and have been applied consistently. If there has been a change in the method from the prior period, you must verify that the change is appropriate in the present circumstances.
For those estimates that you have identified as significant risks, you have an additional technical duty. You must obtain evidence about management's decision to recognize or not recognize the estimate in the financial statements and whether the measurement basis they selected is in accordance with the framework. Technically, the standard provides you with 4 specific avenues for your substantive testing. You are required to undertake one or more of these four procedures based on the nature of the estimate.
Technically, the standard provides you with 4 specific avenues for your substantive testing. To help you remember these 4 avenues for your exam, use the mnemonic ETCR. E stands for looking at subsequent events. T is for testing management's estimation process. C represents testing the internal controls. R is for developing your own point estimate or range.
First, you can look at events occurring up to the date of your audit report. Picture this scenario: you are auditing a provision for a legal case, and just before you sign your report, the judge issues a final ruling. That event provides the ultimate evidence for the estimate. Second, you can test how management actually made the estimate and the data on which it is based. This involves evaluating whether the method of measurement is appropriate and the assumptions used by management are reasonable. You must test whether the data is accurate, complete, and relevant. This includes considering the source and reliability of external data, reperforming calculations, and reviewing the information for internal consistency.
Third, you can test the operating effectiveness of the internal controls over the estimation process, combined with appropriate substantive procedures. This is particularly effective when management has a robust system for routine estimates. Fourth, if management's process is not providing sufficient appropriate evidence, you may develop your own auditor's point estimate or a range to evaluate the reasonableness of management's point estimate. Finally, you must consider whether specialized skills or knowledge in relation to one or more aspects of the accounting estimates are required to obtain sufficient, appropriate audit evidence. If the estimate involves something like the actuarial calculation of liabilities for pension plans, you must ensure you have the right expertise on your team.
Let us move to a very insightful part of Standard on Auditing 540, which is the review of prior period accounting estimates. The logic here is that the past is often the best teacher, and by looking at how management's past estimates turned out, you gain an understanding of their estimation track record. Technically, the auditor is required to review the outcome of accounting estimates included in the prior period financial statements. If an actual outcome is not yet available, you look at their subsequent re-estimation for the current period. The nature and extent of your review should be tailored based on the nature of the estimates and whether the information obtained will be relevant to identifying risks in the current period.
A critical technical point you must remember for the exam is the intent of this review. The logic is not to call into question the professional judgments made in prior periods that were based on information available at that time. Instead, the purpose is to provide information relevant to identifying and assessing risks of material misstatement in the current period.
To help you remember why we perform this look back for your exam, let us use the mnemonic EPICE stands for evaluating the effectiveness of management's prior estimation process. P represents understanding the prior period outcomes compared to actual results. I is for identifying current period risks based on past discrepancies. C stands for obtaining evidence regarding the consistency of management's methods over time. By conducting an EPIC review of the past, you ensure your current risk assessment is grounded in reality, not just theory.
Now we reach the final stage of our work on Standard on Auditing 540, which is the evaluation of disclosures and the overall reasonableness of the estimates. The logic here is that even if the number itself is technically supported by evidence, the way it is explained to the shareholders can still be misleading if it lacks transparency. Disclosures: technically, the auditor is required to evaluate whether the accounting estimates are either reasonable in the context of the applicable financial reporting framework or are misstated. You must also obtain sufficient appropriate audit evidence that the disclosures in the financial statements related to these estimates are in accordance with the requirements of your reporting framework.
For estimates that you have identified as significant risks, you have a higher technical burden. You must evaluate the adequacy of the disclosure of their estimation uncertainty. This means the notes to the accounts should ideally explain the sensitivity of the estimate to different assumptions so that users understand the potential range of outcomes.
A critical technical point from the standard is management's responsibility to follow an unbiased approach in preparing these estimates. As an auditor, you must remain alert to indicators of possible management bias. This involves looking for a pattern where management consistently selects the most optimistic assumptions to improve the financial results.
To help you remember your final evaluation checklist for estimates for your exam, let us use the mnemonic CUB first. C stands for compliance. You must ensure that all disclosures required by the financial reporting framework have been included and are appropriately presented. Second, U represents estimation uncertainty. You must judge if the entity has properly described the uncertainty and the significant assumptions used, ensuring the user understands the inherent risks in the numbers. Finally, B stands for bias. You must review management's judgments to identify whether there are indicators of possible bias that might result in a material misstatement. By checking your CUB, you ensure that the accounting estimates are not just numbers on a page, but are transparent and fairly presented.
By checking your CUB, you ensure that the accounting estimates are not just numbers on a page, but are transparent and fairly presented. This concludes our deep dive into Standard on Auditing 540.
Let us move forward to Standard on Auditing 550, which covers the auditor's responsibilities regarding related party relationships and transactions. This standard is particularly important because related party relationships may provide greater opportunities for collusion, concealment, or manipulation by management. The logic here is that these transactions are not always conducted on an arm's-length basis, meaning they might not reflect the same terms as a deal between two completely independent parties.
Control and influence technically. The scope of this standard is to expand on how Standard on Auditing 315, 330, and 240 are applied to related parties. The first thing you must understand for your exam is the definition of a related party. A person or another entity is considered a related party if they have control or significant influence, whether directly or indirectly through one or more intermediaries, over the reporting entity. The standard also includes entities that are under common control with the reporting entity, such as those with common controlling owners or common key management.
Your objective as an auditor is threefold. To help you remember these objectives, let us use the mnemonic IAD. I stands for obtaining audit evidence as to whether related party transactions have been properly identified. O is for ensuring they have been appropriately accounted for. D stands for ensuring they are properly disclosed in the financial statements in accordance with the reporting framework.
You also have a higher level objective to understand these relationships well enough to recognize any fraud risk factors that might be present. You must conclude whether the financial statements, insofar as they are affected by these transactions, achieve a true and fair presentation and are not misleading. In a technical sense, you must maintain professional skepticism throughout the audit. Even if the financial reporting framework does not have specific requirements for related parties, the auditor still needs to understand the entity's related party relationships and transactions to be able to conclude whether the financial statements achieve fair presentation. Picture this scenario where a company sells all its products to a single entity owned by the managing director's brother. Even if the numbers add up, the lack of disclosure about this relationship could make the financial statements fundamentally misleading to an outside investor. By following your IAD objectives, you ensure that the economic reality of these relationships is brought to light.
Let us continue with Standard on Auditing 550 by looking at a vital collaborative requirement, which is the engagement team discussion. The logic here is that an audit is a team effort, and the collective experience of the group is better at spotting risks than a single individual.
Technically, the engagement team is required to include a specific consideration of how the financial statements might be susceptible to material misstatement, whether from fraud or error, resulting from the entity's related party relationships and transactions.
Engagement team discussion. This is not just a casual chat. The standard requires you to cover several technical areas. First, the team should discuss the nature and extent of the entity's relationships as identified through independent verification, such as checking MBP1 forms or data from the Ministry of Corporate Affairs website. Second, there must be a heavy emphasis on maintaining professional skepticism throughout the audit regarding the potential for material misstatements associated with these relationships.
Third, the team should discuss specific conditions that might indicate hidden related parties, such as a highly complex organizational structure, an inadequate information system, or the use of special purpose entities and off-balance sheet transactions. Finally, you must look at these relationships through the lens of fraud, discussing how special purpose entities might be used to facilitate earnings management, or how transactions between the entity and a known business partner of key management might be involved in fraudulent reporting.
To help you remember what your team needs to cover in this session for your exam, let us use the mnemonic SCAPS, stands for Maintaining Professional Skepticism at All Times. C represents considering complex structures and special purpose entities that might hide the true nature of deals. A is for assessing information from independent sources like MBP1 forms or the MCA website. P stands for evaluating the potential for fraud or earnings management through these relationships. By following your SCAP discussion, the team ensures that everyone is alert to the unique risks that related parties bring to the table.